Ladies and gentlemen, we are officially seeing the effects of tariffs. ADP employment numbers were an actual dumpster fire, missing the consensus by a lot, and we are back in Joe Biden's economy. Remember guys, bad economic data is Joe Biden's fault. Terrible data is Powell's fault for not cutting rates, and good data is Trump's economy. But with cracks in the labor market starting to rear its head, escalation in the Russia-Ukraine conflict all but certain, and trade talks stalling, where do stocks go from here? That is a question we will ask and answer today. So buckle up, we've got a lot to talk about. Let's roll the tape. Welcome everybody to the Daily Recap Show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell as well as the like button and leave a comment for the algorithm. Let's get into it. This is the daily heat map of the S&P 500 and US stocks were flat on Wednesday as Wall Street digested a sharp slowdown in private sector hiring growth. The US-China trade talks kicked off and a 25% steel tariff kicked in. And it was a very mixed day across the board. The S&P 500 virtually flat. And that's because we saw selling in the broad market. Look at consumer defensives, look at energy, look at utilities. These were very red sectors as well as financials, broadly red. But what helped the market move higher was actually the tech space. If you have a look at this sector right here, Google, Meta, Nvidia, AVGO, software as a whole, the semiconductor complex in general, it was broadly green. And the two components of the market balanced each other out. The red right here, the green right here. And that is why the S&P 500 was virtually flat on the day, or gaining ever so slightly up 0.02%. The sectors that detracted from market momentum was energy, utility, staples, financials, and the discretionary space. Interesting here, if you remove Tesla from the discretionary space, the XLY would have been the second best performing sector. You can see Tesla actually fell in excess of 3%. Sectors that actually added to market momentum today was the XLC, materials, real estate, healthcare, technology, and the industrial space, with gold up 0.64%. And we'll talk about why it has to do with some geopolitics. Very mixed price action here to kick the day off, especially as the market was digesting the moves. And then we actually saw the market do what it needed to do. A lot of stocks gained, a lot of stocks fell, very bifurcated in today's trade. And that was true across large caps, small caps, and mid caps. See here for large caps, large cap value took it on the chin. Large cap core and growth gained ever so slightly. Growth as a whole was mid caps, small caps gained. And then this value and core in mid caps, in small caps really took it on the chin today. Particularly value was not a good day for value stocks in aggregate. And that's because the ADP numbers came out. The ADP employment change or private payrolls, whatever you want to call it, we reported at 37,000. This was the lowest number in over 2 years. We missed the consensus of 115,000, missed the forecast of 70,000 as well. And we also got some very poor ISM services, PMIs, 49.9 versus the consensus of 52. And as a result of these numbers, particularly the ADP, Donald Trump came out and absolutely lashed out at Jerome Powell. He said, ADP numbers out. Too late, Powell must now lower the rate. He is unbelievable. Europe has lowered 9 times. In fact, Canada lowered their cash rate today as well. And I think Trump is right. The Fed need to cut at least 50 basis points, in my personal opinion. However, I don't think you can blame this on Jerome Powell entirely. I think Trump needs to take some of the blame. However, this is the path we're on right now. We also had some news on the geopolitical front that wasn't looking too good. Trump came out and said that he spoke with Putin and he told me he will be responding in force to Ukraine's recent attack on their dock airplanes. So we are seeing escalation in this Russia-Ukraine war. And he said it was a good conversation, but peace is not coming soon. And that is why we actually saw gold rally today, metals rally today, the XLB material sector rally today, because it's sort of a hedge against geopolitical untension. On the bright side, though, the EU trade chief, Sefcovic, held constructive talks with the US official Jameson Greer on trade policy. This was very constructive, and it's part of the reason why we actually saw Europe fairly green against some of the other geographies like Canada, like South America, like Mexico right here. But other than that, the US was pretty green. Asia was very green. Australasia was very green. South Africa was very green. A pretty green market in aggregate. Now, looking at some market movers, Apple was down 0.27%, but they actually ripped to the upside, hitting the 206 level. But at the peak right here, we actually got a downgrade from NetM Securities, who said the stock is overvalued amid growing AI competition. And as a result, Apple paired most of those gains. Dollar General was up 16% today, a strong move, right? And that's because they reported first quarter earnings beating the top line and the bottom line. Same store sales actually rose 2.4%, driven by a higher average basket size despite softer foot traffic. So tariff concerns seemingly not a problem for Dollar General, and this stock is up 45% year to date. The real alpha was in dollar stores this year. And then looking at CrowdStrike, guys, it was down 5.36%. That's because it reported its earnings yesterday, very mixed earnings. And if you want the full update on CrowdStrike, you can go ahead, check out my second channel, FinFluential Media. We have a CrowdStrike earnings update right here. And we're also going to do an earnings update for MongoDB, which is ripping in the after hours, 14% after being up 3% today. And that's because it's absolutely smashed EPS expectations by 50%. The company reported $1. The expectation was for 66 cents. It also beat revenue expectations. And this is the general trend. We always see beats with this company and the market rewarding the management team for that. The stock now trading at 228 after closing just under the $200 mark in regular trading hours. So there's going to be an update on MongoDB about 30 to 45 minutes after the upload of this video. And then for everything we saw today, guys, 3,100 advances, 3,100 decliners. We saw net inflows in the NASDAQ 100, outflows in the New York Stock Exchange, with the S&P 500 largely flat, and market momentum continues to remain as is, with shorter term and medium term averages looking really good. Longer term averages continue to look a little weak. We still haven't broken the 50% mark. And if we want the market to really take the next leg higher, we need to see, a breadth thrust in the 100-day, 150 and 200-day moving average. Now, looking at the charts here, guys, it was really a day for large caps. You can see the S&P 500 flat, the NASDAQ 100 gained ever so slightly, but the IWM, the Russell 2000, the RSP, mid caps, the S&P 600, they all fell about 0.2, 0.3% today. Looking a little red here in the after hours, and that's to be expected. We are sort of stalling at the top end of the range right here. The market price action doesn't really look that constructive. I'm actually getting a little bit bearish at the top here, looking for maybe some lower price action. Maybe we do need to have some price discovery here at these lower levels, but we'll see how that plans out. Europe gained 0.5 percentage point. China, very, very green today on the back of everything we actually saw today. And then on the back of the economic data, the weaker than expected economic data, the 2-year yield fell. And look at the 2-year yield, guys, 3.8%. The federal funds rate is about 4.5%. It's 4.2 to 4.5% right now. So I think the Fed need to cut at least another 50 basis points, but they could really do 75 if they really wanted to. I do believe that the Fed need to get the federal funds rate at least in line with the 2-year yield. That would be very, very healthy for the economy in aggregate. But we also saw yields move lower in the 10-year yield, the 30-year yield. The dollar fell 0.5 percentage point, 0.44%. And as a result, TLT and the AGG gained. So what we actually really saw was sort of like outflows from, the IWM, the RSP, higher beta, right, mid caps into large caps and into bonds. Very interesting trade right here with the TLT and AGG up in a very big way. In fact, the TLT is the best performing equity index, or ETF, I should say, today. Bitcoin fell 0.8%, but still above the 100,000 mark, acting very, very resilient. Gold was up 0.5 percentage point. Silver was flat. WTI is down. But let's talk about the S&P 500. And guys, we are at the top end of the range. I am getting, like I said, a little bit bearish here. This price action doesn't really look that constructive. This price action right here feels exactly like what we're seeing right here. Now, I'm not saying we're going to absolutely melt to the downside, but if we do see a little bit of a pullback here into the weekend, I wouldn't be surprised. This price action doesn't feel like it wants to go higher. And if we also just pull up the relative strength index and zoom in a little, we can actually see a negative divergence right here where the S&P 500 has actually moved up, right, made a higher high relative to this high, but the RSI has actually made a lower high. Generally speaking, what we normally see when that happens is price tends to move lower to re-rate. It means the same strength that we saw here is not at the top end of the range, as that could be a little bit of a mispricing in the market. And also to further align with that point, we are, right at the top here of the call wall. So I'm expecting a little bit of downward momentum, but again, I'm not saying we're going to crash. I'm just saying if we are to see downward momentum, I wouldn't be surprised, and we could find support here at the 57.92 area. If we make a higher low relative to this low, maybe even this gap right here, that would be constructive for us to move higher. But if we do pull back a little bit, I wouldn't be surprised. And that's That's, I think, the expectation going into next week or potentially even into this non-farms print, because after those ADP numbers, I think we're going to get a very soft NFP. Now, the market is obviously pricing that in, particularly in stuff like the IWM and the RSP, but we'll see what happens with the S&P 500 and the NASDAQ 100, which the NASDAQ 100, it looks like it does have a little bit of room to run, but very similar situation, right? We've got a negative divergence correlation right here, close to the top end of the range. I wouldn't be surprised if we do have a little bit of a pullback, especially if we get like a weak non-farms, a bit of de-risking into the weekend, and then we'll go from there. That being said, I'm not bearish per se, guys. I'm just saying that we could see a little bit of a pullback, and that would be expected in this market right here. But you don't want to be short. The path of least resistance is certainly to the upside. We're just going to get a little bit of digestion, a little bit of volatility. In fact, it's perfectly healthy. And I think we're going to see that across the board. We're going to see that in the RSP. I think we're going to see that in the RTY as well. I think we're just going to see a little bit of digestion, especially as we see escalations in geopolitics and stalling of trade talks and some tariffs starting to pop up. If we look at the steel tariff that officially got implemented today by Donald Trump. Now, looking at gold, gold continues to be a very good hedge and probably will continue to be a good hedge, especially as the Russia and Ukraine situation continues to heat up. And this is very, very tough price action, ugly price action for gold right here. Ultimately, you want to be buyers at this level. If we break below, you probably want to be out of your gold trade. I personally would not be adding to gold at the top of these levels because this is a high, lower high, lower high, 3 in a row. At the same time, kind of making lower lows. If we do make another lower high and continue the momentum, we could actually see a little bit of a pullback here in gold. What we definitely are seeing with gold is sort of like a wedge that is being formed. I think what we're going to see is the playing out of this wedge, and then we're going to make the next move to the upside and or the downside. I am in favor of gold moving higher, relatively speaking, but I'm not going to predict what's going to happen. We'll react accordingly. That being said, very, very clear price momentum as to what's happening with gold. And I think this will probably play out maybe to late July. So maybe expect significantly more consolidation over the next 6 or so weeks for gold. Now, looking at Bitcoin, guys, M2 money supply is telling us we are about to take the next move to the upside here in Bitcoin. So expect an explosive move, guys. I would sell in the money puts or maybe even get long into an ETF like IBIT or BITO. If you want to play it leveraged, you can look at BITX. I think Bitcoin is going higher. We should see momentum follow suit in the next couple of days. M2 money supply hasn't failed us in 3 years, and it's not going to fail us now, onward and upward. And we officially made a new all-time high in M2 money supply circa around the 140,000 mark. Get ready for the next lift off. And if you think you've missed a move, you haven't really. We still have about 34% of upside from where we are right now. And if this keeps moving higher, so too will Bitcoin. Now, guys, looking at some individual names, some momentum names, if you want to generate some alpha really quickly. For example, one of these names is HINS, right? Guys, right here at the 51% mark, I think this is a great place to probably buy some HINS, have some tight stops, maybe even sell some in the money puts at the $50 area right here. The stock's at $53. Again, tight stops, right? And then looking for a move back up to these highs right here at 66 or potentially the all-time highs of 72. I really like HIMS right here. But again, tight stops, manage risk accordingly. Another name I do like, and I'm sort of speaking about this name, is Abercrombie Fitch. I think right here is a great zone to go ahead and buy. You can see what's sort of stalling out right here. We have a big candle, slightly smaller candle, and now we're sort of like going to consolidate at this area right here. $74 to $75. I think we go higher from here. And I think you could also have some very tight stops, at the high 60 range, 68, maybe the 67 area. If you want to be a little bit liberal, you could say the $66 area, but very, very solid. But this looks like a good place to get long in Abercrombie Fitch. And if you actually just zoom out, just go to the weekly chart, you can see the stock had a massive move up. We've had a massive pullback. And I think sort of around this area right here, we'd probably go back to probably $100 mark. And I think in the very long term, you can definitely see those all-time highs closer to the $200 level. But the stock has digested a lot of these big gains, and the stock is still cheap, trades at about 7 times forward earnings. Now, guys, looking at sentiment, we've seen a massive pullback here. And I said this was going to happen at the start of the week. We were looking very, very frothy here, and we've actually pulled back from closer to this extreme greed zone into the neutral. We are still slightly here in the greed. The neutral camp is at 855. So we are still in greed technically, but don't be surprised if we go into this neutral zone and then find support and then make the next leg higher. And to be honest, the move we've seen in the markets as well as the move we've seen in sentiment has been evidenced by seasonality. When you look at the S&P 500 performance after a 5% May, what we normally see is in the next week, which is currently the week we're in, we actually have a very positive week. And so far, we have had a positive week, up 0.98% average return. But if you look at it next month, it's up 0.98% as well. So in other words, we sort of have a very solid month, we then have a very solid next week, and then we consolidate pretty much for the next month. And that's exactly what I'm expecting as we enter this neutral zone. However, the path of least resistance is continued to the upside, because when you look at the median change, it is 1.31%. So what we're technically saying is, yes, we are going to consolidate, but it's very likely the path of least resistance is to the upside, especially when you look at the next quarter average change, 2.13%, median change, 8.53%. So all in all, guys, if we do consolidate some of the gains over the next week, 2 weeks, 3 weeks in the S&P 500, don't be surprised. Seasonality is telling us that that is the most likely scenario. Now, looking at the macro, looking at GDP, we got the latest numbers here for the OECD and their growth projections. The US is among the economies hardest hit by the Donald Trump trade policy. The OECD said it slashed its US growth forecast to 1.6% this year from 2.8% in 2024. It also cut expectations for global expansion to 2.9% from 3.3%. So we have seen definitely a revision here in the overall growth prospects for the world. We'll see if these pan out. Q1 Fed Now GDP is saying something completely different. We'll see how things pan out as they go along. Now, yesterday, guys, we also got the manufacturing numbers. And look, manufacturing orders did miss. However, what we are seeing is sort of like a bottoming and a reopening. And that is very, very important as it pertains to the economy. This is something that I think is underpriced in the market in aggregate. We also got the JOLTS numbers, and I just wanted to go over them. So this was the JOLTS figures, right? Hires and quits rate in 2024 April and then April 2025. And to be honest, the labor market isn't flashing massive warning signs just yet. Job openings surprisingly increased in April. There's a clear impact from the Department of Government Efficiency, as you can see right here, with the federal government having a very low quits rate, but also a very low hires rate. The quits rate for the wholesale trade workers fell from 1.5% to 1.1%, and the retail trade numbers fell from 3% to 2.5%. Government boosts the lowest hiring rate, as you can see right here, guys. And however, none of these numbers seem to be rapidly deteriorating, but a close look at the chart does help show that policy uncertainty is clearly having an impact, at least on certain areas of the labor market. And we'll see how that continues. But when we look at the pinnacle measure for the labor market, which is the non-farms, and we do get the latest data on Friday, monthly job growth hasn't fallen off a cliff, and unemployment still remains at historic lows at around the 4.1, 4.2% range. Unless we actually see this number, here at the 50,000 mark, somewhere around there, I think the labor market will continue to remain tight, but we'll see what we get with the NFP print. Looking at data for the rest of the week, Thursday, we get initial jobless claims. We also get the balance of trade, that is the exports and the imports, and we also get Fed Harker is speaking. And then Friday, we have the big labor market data. In terms of earnings, we have some pretty big earnings tomorrow, mostly after the bell, Lululemon and AVGO, most notably AVGO. We have DocuSign reporting after the close as well, Service Titan, and then Victoria's Secret. But other than that, the two big names, or I should just really say the biggest name, is AVGO after the close. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, as well as the like button, and leave a comment for the algorithm. Cheers.